chapter 14, utility and decision making. This chapter is very important. So we are still in the same concept. We are doing some فينا نبلش؟ يزعجني على الطلب. So sections to be covered in this chapter. First we have the introduction, section 1. Section 2, expected utility and markets for insurance. Section 3, assumptions and concepts of expected utility. We have only 3 sections to be covered in this chapter. Section 4 is not required, section 5 is not required, all of the sections. Only the first 3, okay? We will talk about market of insurance as an example where we discuss expected utility. You know that people behavior, we as individuals, we have different behaviors. Some of us are risk takers, others are risk neutral, others are risk averse. Okay? So if you want to buy an insurance, how much are you willing to pay for this insurance? If you want to insure your car, if you want to insure your house, how much are you willing, health insurance, how much are you willing to pay for the insurance? If you are a risk averse, if you are a risk taker, you are willing to pay high. If you are a risk neutral, you will pay certain premium for the insurance. And if you are a risk taker, you pay something else. All of this depends on expected utility. How much utility you expect to get from the insurance. Okay? We are going to study the concept of expected utility, focusing on insurance markets. There are also some assumptions and concepts related to expected utility. So what are the learning outcomes of this chapter? First, we have to understand the importance of expected utility theory as a theory of decision making under risk. The expected utility theory is a theory used under risk. When we have risk, I mean, in investment you have risk, right? You have risk regarding, you want to make insurance for the risk. In making decisions, we use the expected utility theory. It helps us making decisions under risk. And we will see more details. Understand the economic analysis of the demand and supply of insurance. We'll see the demand of insurance and supply of insurance. And normative issues concerning the rational choice theory, which is related to expected utility. So, we have in fact 2 types of theories in economics in general. We have, positive economics and normative economics. You studied this early, I think, in 2002. Normative theories affirm how things should or ought to be, how to value them, and which actions are right or wrong. In other words, what constitutes a rational behavior. So, what do we mean by normative theories? Normative theories tells us how a rational consumer, for example, or a rational investor, a rational individual will behave. Okay. How things should be done. Not how things are in reality done, how things should be done. For example, we studied in consumer theory. If you want to maximize your utility, you should be at the highest indifference curve possible, where the slope of the budget constraint equal to the slope of the indifference curve. So the ratio of marginal utilities equal to ratio of relative prices. We studied this before. MUX over MUY equal PX over P1. If you are a rational consumer who wants to maximize utility, you should work based on this equation if you want to maximize your utility. So this is normative theory. Okay? This is how things should be done. How you should value insurance. Okay? How much you should be willing to pay for insurance. You should use certain theories in valuing your insurance. Okay? So if you are a rational behavior, if you want to use rational behavior, this is normative theories. Normative theories are usually contrasted with positive theories, who are descriptive, explanatory attempt to describe reality. So the difference between normative and positive theory describe reality. In reality, consumers or some consumers do not have a rational behavior maybe, and they don't look into MUX over MUY is equal to PX over PY in deciding how much to consume of X and how much to consume of Y. So the reality is different from theory. Positive theory tells us how things are in reality, in real life, they are not. So positive theory seeks to describe or predict how people actually behave. The first one tries to predict how people should behave if they are rational. The second one, how people in reality behave. Is the difference clear? Expected utility theory is used in economics to explain choice under uncertainty. If you want to make choices, for example, how much shall you buy the insurance or not? Shall you have life insurance, health insurance, house insurance, car insurance? For example, for you to make this decision, the expected utility theory could be used. Whenever there is uncertainty, risk, ambiguity, you can use the expected utility theory. So the expected utility theory is a tool aimed to help make decisions among various possible choices. It is a way to balance risk versus reward using a formal mathematical function. We use math to try to balance risk and reward. If you are a rational consumer, you should not pay more than the expected benefit or utility that you should get. True? Okay? So if you want to make an investment and you know that the risk is 20%, okay? And there is another investment with a risk of 10%. If you decide to take the more risky investment, you should expect higher return or higher utility. True? So the expected utility theory helps us to find the balance between reward and risk so that we can take the proper decision based on what? On the expected utility that we calculate mathematically. When faced with a number of different choices, expected utility theory recommends that you calculate the expected utility of each choice and choose the one with highest expected utility. If you have a choice between different types of investments, which one do you choose? You should choose the one that gives you the highest expected utility. Highest expected utility means it takes into consideration the risk and it takes into consideration the return. Based on the risk and return analysis, you can decide which one gives the highest expected utility. I'll give you a simple example. We will see others in the book and on the slides. Suppose you can take an investment in Erbil in Iraq, and the risk is 20% that the business will not succeed. The expected return from this investment is 50%. Okay? And there is another project in Lebanon. The risk is 10% of the business not succeeding, going default. But the return is 15%. Which one do you think gives you higher expected utility? The one in Erbil, because if you look into risk return, even though the risk, of course, it's 20, but you are getting 50% return. This one, the risk is 10, you are getting only 15. So if we look into measures, mathematically, logically now, we don't have now any math used, we will choose the project in error. Okay? So that's why expected utility theory tries to make calculations. Now I give you clear numbers without probabilities, because in expected utility theory we have to look into probability. There is probability of default X, there is probability of making 10% Y, there is probability of making 30% Z. You have to multiply the probabilities by the returns to get the expected utility. This is well known in finance, in fact. In finance, when you want to try to measure the expected return of your project or of your business, you use the utility theory or the expected return idea. So first, expected utility theory and the markets for insurance. This is section 2. Expected utility theory is used to explain how insurance markets operate. So expected utility theory helps us understand how the market for insurance works. Risky prospect is an opportunity where the outcome is unknown. How much would you know how much to pay for a risky prospect, say a lottery ticket? Probabilities are a way of quantifying the likelihood of different outcomes. So, we will talk about insurance in a while. Before we talk about insurance, they try in the book to explain the expected utility theory, giving the example of the lottery. Okay? First of all, we should know what we mean by risky prospect. Risky prospect is an opportunity where the outcome is unknown. And there is an opportunity of making money maybe, but the outcome is not guaranteed, it's unknown. Maybe yes, maybe no. So how much would you, example that we can apply is buying a lottery. When you buy a lottery, lotto for example, how much you should be willing to pay for a lotto ticket if you want to be behaving rationally? Okay? There should be a mathematical way that determines how much you should pay. It depends on what? First, this is a risky prospect. Buying a lottery, there is risk, because you are not sure that you are going to win the lotto. True? The expected return from buying one lotto ticket depends on the probability that you have to win the lotto. The higher the probability that you are going to win the lotto, the higher the price. Yani, suppose in Lebanon only we sell 100 lotto tickets. So if you buy one, the probability to win the lotto is 1 out of 100. But if you sell 1 million, the probability is 1 out of million. Where will you be willing to pay more? Of course, in case 1 out of 100, you are willing to pay much more than if you are buying one ticket out of 1 million ticket. True? So how much will you price the lotto depends on the probability of you gaining the lotto. Or in other words, what's the expected utility if I buy this lotto ticket? So probabilities are a way of quantifying the likelihood of different outcomes. We have to use the concept of probability. A probability is a number between 0 and 1 that measures how likely is an outcome to occur. It's a number between 0 and 1. For example, if I tell you, there is 10 lotto tickets, and you bought one, what's the probability of you winning the lottery? 1 out of 10 or 0.1. The maximum, if you bought the 10, what's the probability? 1. So the probability is a number between 0 and 1. If you buy 5, the probability is 0.5. Valuing risky prospects can be done by weighing all possible outcomes by their probability. This will give the expected value. Risk neutral behavior is between risk aversion and risk seeking. Before we go into this, how do you value a risky prospect? Risky prospect means the outcome is unknown, is not guaranteed. How do you give it a value? Like insurance, like lottery. You have to take into consideration the probabilities and the outcome. And what's the suppose I tell you the following, please. And on the numbers, I'm giving you numbers. Try to focus on the example. We will look into another example in the book. If you make an investment in Lebanon, the probability of you making $1,000 is 50%, and the probability of you making $10,000 is 50%. So you want to make an investment in Lebanon. There is a probability of 50% that you make $1,000, and probability of 50% to make how much? $10,000. The question is, what's the expected return of this investment? How much do you expect to earn from this investment? You have to multiply the probability, which is 50%, by the return. So 50% for the first project times the return, none of the first, it's the same project in Lebanon. Okay? I will repeat. I have money and I want to start a business in Lebanon. I made a study, I found out there is 50%, and in worst case scenario, in 50% probability that I just make $1,000. But if the economy is growing, etc., there is a 50% that I make from the same project $10,000. So what's the expected return from this investment? I multiply the probability, which is 50%, first one, times 1,000, plus 50% times 10,000. So 50% times 1,000, this is 500, plus 50% times 10,000, this is 5,000. So 50% times 10,000 is 5,000. I add them. The expected return of this investment is 500 plus 5,000, or $5,500. I multiply the probability by the return. So the expected return of this project is $5,500. Okay. Now, there are factors that affect my decision. It depends whether I am a risk taker or risk averse or risk averse. If I'm a risk taker, I won't be happy maybe with this return. I will be happy with this return. If I'm a risk averse, I will not be happy. I will say there is 50% chance of losing, so I will not go into this project. Or I just gained $1,000, I don't want to go into this project. So risk. Some people are risk neutral, some others are risk averse, others are risk takers. The behavior of people towards risk also affects their decisions. Okay? So again, in case of insurance, if I'm a risk taker, I may not buy insurance, or I may buy it, but if its price is low. If I'm a risk averse, I will buy it even if the price is higher than expected. Even if it is higher maybe than the expected utility. Okay? So person behaving in risk averse manner if they are willing to pay less than a risky prospect expected value to take part in it. If I am what? A risk averse, I am sure I am willing to pay less than the expected value. If I am a risk taker, risk preference, yani, or I behave in a risk preference manner, I am a risk taker. In other words, risk preference means I'm a risk taker. You will be willing to pay more than a risky prospect expected value to take part in it. So, in the example that I gave you, what's the expected return of the project in Lebanon? 5,500. So if I'm a risk preference, I may be ready to pay more than when this is the case of investment. It's different. Okay, I may go into the project and I may not go into the project. But regarding the lottery, for example, if the expected utility, if I buy the lottery, is 10,000 Lebanese pound, if the expected utility and the expected return, I measure the probability, okay, by the return. I will explain it more in the lottery case. Suppose the lottery pays you $1 million. And there is 1 million ticket, 1 million lottery ticket sold in Lebanon. What's the expected utility or return from buying one lottery ticket? There is $1 million profit. The lottery, if you win it, you will gain $1 million. And there is $1 million tickets sold. There is a probability of me winning the lottery 1 over 1 million. But 1 over 1 million times, what's the return? $1 million. So the expected is $1. If I'm a risk taker, I may buy it for $2. If I'm a risk averse, I will not buy it even for 1. I will buy it for 0.5. Okay? So risk taker will be willing to pay more to be part in the project, here to be part in the lottery. Risk averse, I am not ready to pay even the $1. Risk neutral, he pays $1. Exactly. Choice under uncertainty is often characterized as the maximization of expected utility. The utility function whose expected value is maximized is concave for a risk-averse agent, convex for a risk-lover, and linear for a risk-neutral agent. In the risk-neutral case, expected utility of wealth is simply equal to a linear function of expected wealth, and maximizing it is equivalent to maximizing expected wealth. So it's a bit complicated. We will see the graph and we will explain in the book. So we are talking about in section 2 expected utility. We said that how do you make choice under uncertainty? Please concentrate before we look into the book. How do we make choices under uncertainty? By maximizing the expected utility. So the expected utility theory, we can use it to make choices or decisions under risk or uncertainty. We agree on this. They tell us here, if the utility function whose expected value is maximized is concave for a risk-averse agent. If you are a risk-averse, the utility will be concave. If you are a risk-lover or risk-taker or risk-preference, you behave in a risk-preference manner, it will be convex. And if you are risk-neutral, the utility will be straight line. So we can look at on page 153 at the first one, the risk averse behavior. You can see that the utility is function. You can see, can you see the utility function? Page 153. Can you see the utility function? You can see it? Page 153. All of you have books? Do you all have books? You don't? Both of you? Okay. Okay, give them one book. Okay. page 150, you can see that the utility function is concave in case of risk averse. Utility is measured on the y-axis, income is measured on the x-axis. Why is it concave?
Because it is willing to pay more.
I am a risk.
Not willing.
I am a risk averse. I am not willing to pay as high as the expected utility. I am willing to pay less. Okay? While in case I am risk neutral, it will be constant. As expected utility goes up, I am willing to pay in the same proportion. In the same proportion. Okay? While this is the case of constant marginal utility. The last one, in the case of increasing marginal utility or in case of risk preference behavior, you can see that it is convex. In other words, he is willing to pay more than the expected utility. So this is the graph that you need to know that the utility function differs according to the behavior of the individual or people. Okay? It can be concave, it can be linear, it can be convex. Now, certainty equivalent, a person's certainty equivalent of a risky prospect is the most that they would be willing to pay for it. Expected utility, it is the probability weighted sum of the utilities of its outcomes. These are definitions. Now, what do we mean by certainty equivalent? A person's certainty equivalent of a risky prospect is the most that they would be willing to pay for it. So the maximum that you would be willing to pay for a risky investment or risky project is what we call it certainty equivalent. The certainty equivalent differs between people. If you are a risk taker, the certainty equivalent is different from the case if you are a risk averse individual. Of course, if you are a risk taker, certainty equivalent is higher. If you are a risk averse, certainty equivalent will be lower. Regarding the expected utility, I told you how to measure the expected return. I gave you the example of the investment in Lebanon, 50%, 50%. The expected utility is the same concept. It is the probability weighted sum of the utilities of its outcome. Probability weighted sum. Why did we say probability weighted sum? We multiplied the 50% probability by the utility, which was 1,000, plus 50% times the other utility, which is 10,000. This is the probability weighted sum. This is what we mean by probability weighted sum. Did you get it? 50% times 1,000 plus 50% times 10,000. You need to understand here that the sum of the probabilities should be 1. So if I have 50%, in 50% of the times I will make 1,000. And in 30% of the times I will make 10,000. Can you calculate the expected utility? If I tell you a project pays you $1,000 50% of the time, or the probability is 50%, and there is 30% probability of making $10,000. Calculate the expected return of this project. 50% times 1,000 plus 30% times 10,000. But there is 20% not included. Now I know that 50% of the time I can make. Are you concentrating? Okay, please, what are we discussing? You? No, not you, you. Yeah. Can you repeat the example? So why were we giving the example? For what reason? Expected utility, which is similar to expected return. I'm telling you there is a project that gives you $1,000 50% of the time and $10,000 30% of the time. Calculate the expected utility. You said we multiply its probability weighted sum. We multiply 50% times 1,000 plus 30% times 10,000. But this is not the expected utility. Why? Because I don't know in the 20% of the times how much money will I make. In this case, you cannot calculate the expected utility. You know that 50% of the times, or probability that you make 1,000 is 50%. Probability to make 10,000 is 30%, but there should be another 20%. If I don't have it, I am not calculating properly the expected utility. It should, the sum of the probabilities should be 1. I have 50, I have 30, there is remaining 20. If I tell you now 20% of the time I make 5,000, now I can calculate the expected utility. I multiply 50% times 1,000, 30% times 10,000, 20% times 5,000, I can calculate the expected utility or expected return in finance, we call it. Now regarding markets for insurance, before we move to this point, do you have any questions?
Can you repeat the example?
Yes. I give this example to understand how to calculate the expected return or expected utility. I tell you, there is a project that pays you, you make analysis of a project, and you find out that there is a probability 50% that you make $1,000 during this year from this project. And there is 30% probability that you make $10,000 from this project, in case you had high demand. And if things were normal, acceptable, you will make, in 20% of the time, you will make $5,000. So there is 50% to make $1,000, 30% to make $10,000, 20% to make $5,000. What's the expected return of this project or utility? You multiply, it is defined here. The expected utility is the probability weighted sum of the utilities of the outcomes. The first outcome is $1,000. The probability is 50%. So I multiply 50% times 1,000 plus, because it's weighted sum, 30% times 10,000 plus 20% times 5,000. I add them, I get the expected utility. Now, if I am a risk taker, I will pay more than this number. If I am a risk taker and I will go into this project maybe with less than the expected utility. If I am a risk averse, I want more utility. I will go to another project with less risk. Now regarding insurance, insurance is like any other service or good. It has demand and it has supply. But why we study insurance in this chapter? Because insurance, when you are making a decision to buy insurance, or you buy insurance because of risk and uncertainty. If there is no risk, will you buy the insurance? The answer is no. If risk is zero, will you buy insurance? No. If there is a risk, you buy insurance. Now, if you are a risk taker, you will not buy insurance unless its price is lower than the expected utility. But if you are a risk averse, you are willing to pay for the insurance even if its price is higher than the expected utility. I'll give you a numerical example. You bought a car that costs $100,000, new car. The probability of making an accident per year during the year is 5%. There is a probability of making an accident that might destroy the car. The probability is 5%. The first question, calculate calculate the expected loss or utility if you buy the insurance. To make things more clear, let me give you the insurance. The insurance costs, how much shall the insurance cost? This is the question. How much shall the insurance cost if it is too risky?
High.
Too risky, all risk, they cover the $100,000 if your car is destroyed. There is probability of 5% for the car accident to happen or for the car to be destroyed. So the expected price of the insurance should be 5% times 100,000 or $5,000. Now, if you are a risk taker, you are not willing to pay the 5. You are maybe willing to pay 3,000. Not 5. 5 is high for you. If you are a risk averse, you may be willing to pay 7,000. If you are risk neutral, you are willing to pay 5,000. So expected utility, what's the relation of expected utility with the insurance? Expected utility tells you how much will you benefit from this insurance. I will benefit from this insurance in case I had an accident. What's the probability of having an accident? 5%. If I have an accident, how much will the insurance pay me? $100,000. So what's the expected utility? 5% times 100,000 or $5,000. I will be willing to pay more than this 5,000 if I'm a risk averse. I will be willing to pay less than 5,000 if I'm a risk taker, and only 5,000 if I'm a risk neutral. Is the example clear? Is the example clear?
Yes.
So how much, let's look into another example. How much money would you pay out for insurance, or what is your certainty equivalent for this risky prospect? We call it certainty equivalent. What's a certainty equivalent? It's the most that you would be willing to pay for a risky prospect. There is a risk in case you have a car, there is a risk that it will be destroyed. How much you will be willing to pay for insurance? What's your certainty equivalent, in other words? What is the maximum that you will be willing to pay for this risky issue? Example, house insurance against flooding. This is an example. the house is worth $100,000 and flooding happens once in every, not 200 years, not 200 years. I think it's in the book, how many people are, 200 years. Okay? You bought a house that cost $100,000. An insurance company called you and asked you, do you like to insure your house for flooding? Because every 200 years a flood is happening, and it might happen during maybe the coming years, we don't know, on average every 200 years. And your house might be destroyed. We pay you back all the price of the house. Are you willing to buy this insurance?
No.
You might say no. This no is not a rational answer. Okay? And this doesn't show irrational behavior. Let us see the 3 cases to consider. Case 1. Before we look into the cases, of course you know that we have 3 cases. Case 1 will be risk neutral, case 2 will be risk averse, case 3 will be risk taker. The question is, what's the probability or what's the expected utility in case I buy this insurance? How much I should be willing to pay? If I am, of course it depends whether I am risk neutral or not. But what's the utility that I get? 1 over 200 times 100,000. Why 1 over 200? Because the probability that it might happen is 1 over 1 time every 200 years. Times how much will I get back? $100,000. So what's the answer? 100,000 divided by 200. 500. The answer is $500. True? This is the rational price. This is the rational price. Because there is probability 1 over 200,000, 1 over 200 that this flood will happen. And if it happens, I will get back $100,000. So how do I calculate the expected utility? 1 over 200 times $100,000. And the answer is $500. If I am a risk taker, I will not be willing to pay 500. I may be willing to pay 0. Maybe I don't get it. Maybe 400. But of course less than 500. Risk neutral, I pay 500. Risk averse, I may pay 1,000 or 700. So the 3 cases are: if you pay 500 as insurance premium, you will be risk neutral. Clear؟ واضح اللي عم بشرحه؟ واضح؟ You ورا certainty equivalent will be $500 in this case and equivalent to its expected value. What's the expected value of the? How do I value the insurance? How do I price the insurance? Expected value is equal, the price or the expected value is 1 over 200 times 100,000. If I am a risk neutral, my certainty equivalent will be equal to the expected value, which is in this case 500. In case I am risk averse, I will be willing to pay more than the 500. In other words, the certainty equivalent is greater than the expected value. The expected value is 500. How do I calculate it? Probability times outcome or return. It's 1 over 200 times 100,000, which is $500. We call this the expected value. This is the price. If I am risk neutral, the certainty equivalent, that is how much I am maximum willing to pay, should be equal to the expected value. If I am risk averse, I hate risk, I like to insure, I will be willing to pay more than the expected value, so my certainty equivalent will be higher than 500, while if I am not willing to pay this amount for the expected loss, I will be a risk taker. So if I'm a risk taker, my certainty equivalent, that is how much. The maximum that I would be willing to pay is of course less than the expected value, which is $500. Clear? Do you know the difference between expected value and certainty equivalent? Expected value is the price, the rational price, while the certainty equivalent is how much I am willing to pay. If I'm a risk neutral, I pay the expected value. If I am risk averse, I pay more than the expected value. If I am risk taker, I pay less than the expected value. This is in case of insurance. So this is the demand. How do you price insurance? It depends on. So what's the price of the insurance in the market? Will it be 500, 400, or 700? It depends on how much. The demand will depend on how many risk neutral we have, how many risk averse, how many risk takers. If the price is 600, only risk averse will buy it. If the price is 400, of course risk averse will buy it and risk takers will buy it. If it is 500, only risk neutral and risk averse will buy it. So the demand will depend on the price. Price of insurance is the premium that you pay. We call it premium, insurance premium. Okay? Regarding the supply of insurance, insurance companies who supply insurance usually cover risks that are independent. Insurance companies make money by charging risk-averse customers an insurance premium that is greater than the expected loss to remove the risky prospects. How do insurance companies make money? They usually sell insurance to risk-averse customers who are willing to pay more than the expected value. Usually the insurance company will make calculations and they will determine the expected value. In this case, in this example, it is 500. The insurance will sell it for 600. To whom will the insurance, who will buy it? Only risk averse. That's why they make a real profit. Okay? Another important behavior about insurance, insurance, supply of insurance. Who supply insurance? Companies, insurance companies. Who demand insurance? Those who are at risk. You might buy health insurance, you might buy car insurance, home insurance, etc. Life insurance. There are many types, many products by insurance companies. Okay? And insurance usually supply insurance that cover risks that are independent. Dependent risks make the insurance company lose. For example, insurance of the house, and insurance of items within the house. These are dependent. These are two dependent. In case a flood happens, you have the insurance company. Are you listening? Suppose an insurance company tells you will insure your house for $100,000. It is telling you that the house, we are talking about the price of the house without including the furniture, etc. that are within the house. The insurance company usually will not give two services, insurance for the house and insurance for the furniture, because if it happens, both are going to be destroyed at the same time. So here you are providing dependent insurance, and the insurance company usually provide independent services. Okay, we will take a break here if you have no questions. Any questions? Questions? Is it clear the demand and supply for insurance? Okay, we will take 10 minutes break. Please can you turn off the...
شوفي يا ماشي ماشي
مصطفى حمود، ملاك درويش، مارون الفيك، مارون، نمر، لارا، محمد شكر، مصطفى عمار، مصطفى عمدوي كتير
مرتين
من أصل عرب، شرب العبيد، نادر ليلو، حياة، علاء، ريساء، هاني، رفعة، أنطوني، علاء، نادر، غادة، علا، نيكول، جوال، بول، روان، زينة، خاء، جاد، نبال. Before we continue this chapter, I want to remind you your midterm is on the 16th of April. We are going to have next Friday, I think, is off.
Yes.
And we might have another Friday.
Yes.
Okay? So we are going to do one make-up for both Fridays. Both Fridays we'll do one make-up session for them. Okay? For the midterm, until now, they say that you have until chapter 15. So 14, and today we will have one more chapter which is 15. Okay? We will cover it not next Friday, the week after. Okay? And we might have one session before the midterm as revision session. We do it as make-up where we will review and discuss points related to the midterm or exam. Okay, the last few points in chapter 14, it is the last section, assumptions and concepts of expected utility. In this last section, or section 3, they tell us some important things. First, they tell us that sometimes it is not easy to use the expected utility theory that we discussed. Even though it is very important, it can be used, and it is used, but sometimes we cannot use it. And the reason is that we do not always have the probabilities. For you to be able to know, to use the expected theory, expected utility theory, you should know the probabilities, because for you to calculate the expected value, you need to know the risk weighted or the probability weighted outcome. Right? So suppose you want to buy insurance, but you do not know the probability of how many years for the flood to happen. You can calculate the expected value. You cannot use anymore the expected utility theory. You don't know whether it is 500 or 1000. But if you know the value, you can decide. But if you don't know it, it cannot be calculated because there are no probabilities are unknown or uncertain, then we cannot use the expected utility theory. It's important, but sometimes there are obstacles that make us unable to use it. Okay? Also, they discuss here that the expected utility theory can be used as a positive or normative theory. Positive means how people should behave, or normative to explain how people, what people should do. So it can be positive to tell us how people in reality behave, and it can also tell us how people should behave. Okay? How people should be, if you are rational, usually. If you are rational, you would calculate the expected value and you are willing to pay certainty equivalent that is equal to the expected value. This is logical, rational behavior. So this is what you should do. But sometimes you are willing to pay less, sometimes you are willing to pay more, because you are either risk averse or risk taker. Okay? So the utility theory can be used as a positive theory as well as a normative theory. This is one. Two, there is what is known as the linearity probability axiom. The linearity probability axiom means people rank a risky prospect in terms of its expected utility. You rank your risky prospects. What are your risky prospects? In risky projects. Okay? Risky means there is an opportunity where risk is not known. So you rank your risky prospects according to the expected utility. If you have many projects that you want to choose from, you should rank them according to the expected utility. You should choose the one that maximizes your expected utility. If you remember in part 1 of DD309A, we studied consumer behavior, right? And we studied about firms' behavior. Consumers should maximize their utility. But because prices are known and your budget is known, we didn't talk about expected utility. Because you know the prices of X and Y, and you know your budget. So you know the utility. Right? There is no need to, there is nothing, we didn't talk about expected utility. Expected utility is studied in case of uncertainty or risk. Okay? That's why when we talked about expected utility, expected value, we gave the example of insurance, of lottery, okay, of risky projects, risky investments. For risky investments, investors use expected return or expected value or expected utility indirectly. Okay, they use the expected return. If you have to choose between different projects, you choose the expected return from each project. The one that gives you the highest expected return, you should choose it if you are rational. You should choose the one that gives you the highest expected return. What's the expected return? It's related to the probabilities. It's the sum of probabilities and outcome probability sum. Okay, like I gave you the example of expected return of $5,500. We make the calculations. Okay, 50% times 1,000 plus 50% times 10,000. So the expected return from this project is 5,500. If you have many projects, you look at the one that gives you the highest expected return. Of course, but for you to compare different projects, you should start with the same capital. And if one project gives you expected return of 5,500 and another gives you 10,000, which one do you choose? Of course, you will tell me I will choose the 10,000. But you should, it depends also on how much you are paying as initial investment. If for 5,500 I pay $10,000 to make this money, for the other I pay 100,000, no, I will choose the first. Okay? There is something called intransitive preferences. Transitivity could mean so what do we mean by intransitive preferences? Intransitive comes from transitivity. Transitivity could mean a constraint on the possible preferences that a person could have in number of different hypothetical decisions. So what do we mean by transitivity? Constraints on possible preferences. What do we mean by constraints? Yes, constraint حواجز. Okay, barriers. Sometimes you want to make a decision regarding whether to buy the lottery or to buy the insurance or not. But you may not, you may have constraint. You don't have enough information for you to determine the expected value. Okay? Here you have constraints. So you cannot determine properly the expected value. So your decision will not be accurate. Okay? So if there are constraints for your hypothetical decisions, it means there is, for example, lack of certain given information, there is the problem of transitivity. Second possible justification for requiring transitivity is that utilities assigned to an option should not vary depending on the context in which the option is offered, but on the qualities of the option itself. So if you have two options, you want to choose between them, you may choose based on not only on the expected value, but also on certain quality of the option. In other words, I can give here an example. If you have two projects, one in Lebanon and one in another country, like in Syria now, suppose the expected return in Syria is higher. Let's say it's higher. The expected return. The expected return is higher, even with the risk. Sometimes if there are risks, there are high opportunities. Like in Iraq, even during the war in Iraq, many international companies were searching to buy land in Iraq because they wanted to start their project immediately when the war ends, because they know there will be high demand. So there was an available opportunity. Anyway, let's suppose now you have two projects, but the expected return for the project in Syria is higher. Would you choose the one in Syria? They are telling you here that you should look at the quality of the option. The quality of the option, quality of choosing now a project in Syria, there is a risk that you might die, there is a risk that you might, you have many risks that you have to consider. So it's not enough only to say that in this case the expected return is high. Okay? Linearity and behavioral evidence. Linearity axiom predicts, so that the linearity axiom that we were talking about, it predicts that if you add the same probability of winning the same amount of money for two options, you just increase the utility of each option by the same amount. And so your preference between these two options should not change. What does the linearity axiom say? Linearity axiom rule says that if you have two options, okay, and you add the same amount of money for each option one gives you $6,000, option 2 gives you $5,000. If you add to each option 5,000. The first one should give you 10, the other should give you 11. So your preferences should not change. This is the linearity axiom theory. It means if you add the same amount of money to two different options, your preferences should not change. In this way, you are being what? Rational in your behavior. The linearity, it's linear. It's linear, yani. If I add here 10,000, the other one will add by 10,000. Okay, so if you add the same quantity of money, in this case, the preference between these two options should not change. Linearity is a desirable general, it's a principle. Why it's a principle? Because sometimes you think that if you have two projects, if you put more money in this project, you will have higher return. But in reality, the expected return does not change if you increase your money or your investment. يعني إذا في مشروع بكلف $100,000 واكسبكتد ريتيرن منه، يعني بعد ما طلعت بالبروبابيلتيز هي $10,000، يعني 10% من الانيشال انفستمنت. يعني انا بحط 100,000 expected return توقعه هو انه اربح 10% بعد ما عملت probabilities، يعني 10,000. اذا حطيت 200 قد ايه راح يكونوا 20,000. The dollar 10%. It doesn't change. This is what they are trying to tell us. It doesn't change. The expected return doesn't change if you add more money here. It will remain the same ratio. That's why if you have two options and you add same money, and you cannot say I have two options, the expected return for the first one is 10,000, for the second is 15. If I put 100,000. If you put 200,000, it will remain, this will be 20, this will be 30,000. Okay? They will both rise in the same way. This is the linearity axiom. Finally, as we said, some situations expected utility cannot be used because probabilities are unknown. This is what we, in the book, the title of uncertainty in section 3. Uncertainty means sometimes we cannot use the expected utility theory because of uncertainty. Uncertainty means probabilities are unknown. How can you know calculate expected value of insurance if you don't know what's the probability of the risk to happen? Now, if you want to buy a car insurance, they tell you the price is, suppose, $100. If you want to calculate the expected value, you should know what's the probability of you using this insurance times how much you will get from the insurance. This will give you the expected value. For you to do this, you should know how many car accidents happen in Lebanon. How many cars do we have? We have 1 million cars. We have 10,000 accidents. So the probability is 10,000 over 1 million, so it is 1%. I will get $10,000 in case I made a car accident. So 1% out of the times 10,000, this is $1,000. So you should be willing to pay, if you are risk neutral, $1,000. This is the expected value. The certainty equivalent is $1,000. If you don't know the probability, there are no data or statistics in Lebanon, you cannot know what's the probability of making a car accident. Okay. That's why, for example, in Lebanon, there is something that companies do not use, insurance companies. You know that if you are, for example, 75 years old and you are getting car insurance, there might be higher possibility that you make car accidents because of there is probability of you not having problems, health problems. They don't look into these issues. They don't look, whenever you make insurance, they don't look into, like other countries in the world, other insurance companies, they don't look into your file. How many car accidents did you have in the past? how many fines يعني كم ضبط هيك سرعة ومخالفات سواقة، عندك بوينتس على دفتر السواقة، كلها هيك إذا كل ما تكون أنت عندك more fines يعني more risk you are charged more. There is programs that calculate the expected value for each group of customers. If you are living, for example, in a very poor area, they charge you higher insurance than if you are living in a wealthy, rich area. Because if they are living in a poor area, they think that you might not be very watchful, your behavior will be, if you may be affected negatively. If you are rich, your behavior is different. So they looked into many factors whenever they set the insurance premium. Okay. In Lebanon, as you can see, it's flat, except health insurance, of course. Health insurance, they give you, depends on the age and on the health situation of the one who wants to buy the insurance. So uncertainty is usually present in decision making within policy context. Whenever, for example, a government wants to start a project, or whenever any policy decision that the government wants to take, sometimes they do not have all the information to determine the expected value. Expected utility theory cannot model choice situations that are uncertain. If you don't have probabilities, if you don't have the probability of the risk to happen, or the probability to make this profit, if you don't have the probabilities, you cannot use the expected utility theory, because you cannot calculate the expected utility or the expected value. So this is very important. For you to be able to use the expected utility theory, you need to, probabilities should be known, because you use them in your mathematical calculation. Questions? So in this chapter we covered expected utility theory, and we looked into the market of insurance, and finally we talked about uncertainty and some where the expected utility theory cannot be used. It is very important theory. It is used in finance, where they calculate expected return of investment. Financial companies use expected return, because the expected return is risk-weighted. Okay? So if I tell you to finalize the session with this example, suppose you have $10,000, and you can put this $10,000 in a bank and get 10% interest with zero risk. Or you can open a restaurant with this $10,000 and make $10,000 profit. $10,000 profit, but with 75% risk. Which one will you choose?
It depends on
No, it doesn't depend on it. Before it depends, what is that?
Profit 10,000.
No, the first one is 10,000, you get 10%. Based on what, if you understood what we studied, you should give a number. You should calculate the expected return of each risky prospect to determine your certainty equivalent. The first one, $10,000, 10% with zero risk. So what's the expected return with zero risk? Yes. So the expected return is $1,000, because the probability of getting them is 1. You are 100% sure that you will get the 1,000. So the expected return of project 1 or investing them in a bank is 1,000. For the second one, I will make $10,000, but there is a possibility of 75%. So you will make 7,000, expected return is 10,000 times 75%, or 7,500. So the expected return from the second project is much higher. So which one will you choose? The second one. If you are risk neutral, we choose the second one. If you are risk averse, we choose the second one. If you are risk preference, we choose the second one. In this case, you will choose the second one because the second one maximizes your utility. But if they both give you the same expected return, you may choose the first. Not you. You will choose the first. Okay. So expected value, especially if you are rational. Okay, we are talking about rational behavior. Now, if you don't know what's the you cannot determine the percentage or the probability of making the $10,000. Is the probability 75 or 1? Maybe it is 1%. If you don't have the probability, you cannot make a choice. You cannot use the expected utility theory. So for you to be able to use it, you need information. That's why it is not all. It cannot be used in all situations. Do you have questions? Okay. Remember, yes. Start studying for the exam. For the midterm. Okay? See you next week.